fixed income space for you. Jim Stening from FIG Securities. Jim, nice to key off some hard data rather than Women's Weekly and Julia Gillard and all that. One viewer saying, I'm glad she appeared in Women's Weekly rather than Playboy, but we can kind of put that one to one side, key off firm numbers here. Tell me about CPI. Did you see a surprise in the numbers?
Yeah, well, I think it was the surprise was on the downside. There were, in the components, there was some volatility. But interestingly, I think if you go back to previous comments from the RBA, they were expecting underlying inflation to come down to around 2.75. So, interestingly enough, they've got it pretty well bang on. So, I don't know that it was necessarily a surprise to the Reserve Bank.
Is it the case, though, that when we always strip out those volatile measures, the food, the energy costs, and yet those are the core concerns for most people. How's that understood?
Yeah, well, I think what's important is, and the TRIM mean, the way it operates, is that over time, if in fact there is a trend emerging in those factors, it is reflected. But I think it's really important that some of those, I suppose, uncontrollable aspects of the CPI are taken out of a reading and when we're setting monetary policy.
But things like, utilities, wage pressures, they are included, are they not? And again, I mean, how much can the Reserve control those even with that crude mechanism of rates?
Well, that's right. I mean, monetary policy is a blunt instrument, and I suppose, given the Reserve Bank's charter, 2 to 3% inflation, their focus really is it has to be both headline and underlying as well. So it really is about the longer term trends. And interestingly, with monetary policy, I mean, what we've got is a historical print. The balancing item in their decision-making process is the forecast for inflation. But arguably, with yesterday's result, they'll be less concerned about that, the forecast for inflation. And
less concerned that they could sit it out till, what, 2011? Is that what you're calling now? Is that too...
Well, my personal view is that rates or interest rate, the bias is neutral to tightening from the Reserve Bank. I think that, interestingly, we're hearing a lot about Australians saving. We're hearing a lot about, not spending and looking for bargains and things like that. And when you go back to Stephen's comments in the past, I mean, that's something that he was very excited about, that development, starting to emerge. And this is more evidence of that. And I think so. It's not necessarily, in his words, not necessarily a bad thing.
Is that something that he's brought about, or is it something that the banks themselves, and you look at the state of the credit markets, there's hoarding going on. There's unwillingness to lend.
Yeah, well, I mean, there's jawboning, I suppose, but the reality is, access to credit is more difficult, and it's more expensive. I mean, the banks, we've seen recently that their margins are increasing, or they're feeling the pinch, particularly in the deposit space. And so that cost's being fed through to borrowers, particularly business borrowers, and particularly various sectors like property.
The thing is, it's not as if the banks don't have cash. If we're even talking globally, there was this thematic, was they're not ahead of the stress tests of banks putting their money with the ECB overnight, where they would be getting interest on those deposits themselves, and so that was only going to benefit them. But it's actually about going the next step, lending to the private sector, and then the follow-through. That's right. I mean, that's, I suppose, the overall, indicator of confidence is when that sort of leverage moves back to the private sector. You can cajole them, and that was the talk as well with the Fed. Was that another tool they could use on the way out of this to actually say, well, that discount rate, is going to be lowered even further to make it less attractive? There wasn't that.
Well, it's not very sexy at the moment.
It's not.
Yeah. I don't know that that's an actual, practically a really viable tool for them. I think that the Fed is in a bit of a dilemma. I think that we've talked about this. I mean, the small business is finding it very difficult to get access to credit, and the employment numbers are really reflecting are a good barometer of progress in that space. I mean, I think that one of the things that's brewing in the US at the moment, particularly this patchy report overnight and comments from Bernanke about uncertainty. I think this non-farm payrolls number for in early August next Friday night has potential to provide real volatility.
Now, why is that so interesting when it's backward-looking? Correct me if I'm wrong. Why will the markets key off that?
Well, I think what people are focusing on is this stubbornly high unemployment rate in the US, and fundamentally, you've got to see some improvement there before you can get any confidence.
Yes.
And so, not a bad figure on Friday night doesn't necessarily mean that the trend isn't improving, but it would be very damaging, I think, to the sentiment in the marketplace.
Do you think people were getting ahead of themselves looking at the private sector component of these surveys as well? The Labor Department report showing private employers in June hiring at a faster pace than in May, going from 33,000 up to 83. But a lot of that was part-time work. And it's taking the next step. It's gaining the confidence to convert those jobs.
Yeah, well, I suppose that's a natural progression in the employment cycle. I mean, if businesses aren't confident, then they don't take on full employees. There's various responsibilities associated with that as well. But
if you look at that downturn in manufacturing in the Beige Book, it would seem to suggest that there won't be that natural progression through.
Well, that's the uncomfortable thing about all of this. I mean, you know, now I can see why Bernanke was saying there's unusual uncertainty, and that the Beige Book is really symptomatic of that. It's showing that there is this sort of bumping along the bottom sentiment.
So why is he the whipping boy? Just by default, he can't win either which way, can he? If he's too bullish, they'll say, well, actually, the Beige Book makes you out to be a liar, Ben. You know, what does he do?
I suppose, you know, he's used to being in those sort of predicaments. Look, I think it's.
But then you've got the curious. Yeah, go on. I mean, answer it.
Well, I think it's something that given that we are experiencing statistics that contradict each other over, you know, a period of weeks, it's important, I think, for them to stay back and be more analytical, because any move would you know, certainly it's a sort of a trend-changing adjustment. And
then further kind of, well, not singing from the same hymn sheet, Mr Honing again chimes up and says, let's raise rates to 1%. As if to say, well, we've got inflation in the system, when clearly we know that actually their annualised inflation is not annualised inside a band at all. It's below the band.
Yeah, well, I suppose, you know,
deflation.
That doesn't really make sense in the current environment at all. No.
All right. Jim, to be around the Fed and see their musings, their deliberations. We must leave it.
That's right.
We haven't even talked Dodd-Frank, but that's still to be dissected. We'll talk with it on you next time.
Thanks, Carson.
Thanks so much.
Cheers.
Jim Stening there from FIG Security.